Hi students, welcome to Sunil's tutorial. I'm Sunil Mirwani and today we'll be doing this chapter called as amalgamation. We're going to do question number 14 in the books of Fat and Thin Limited. Right? Now they said that the following is the balance sheet of Fat and Thin Limited. On that date, Fat absorbed Thin. That means Fat bought over Thin Limited. All assets and liability of Thin Limited other than investments in Madhyam Limited were taken over at 40 lakhs. Thin Limited was to receive from Fat Limited 15% debentures of rupees 12 lakhs at par and equity shares of the par value of rupees 10 each at a premium of 4 per share for the balance. Preference shareholders of Thin Limited were allotted the debentures received from Fat Limited and 10,000 equity shares of Fat Limited in full discharge of their interest in Thin Limited. The balance equity shares received from Fat Limited and the investment in Madhyam Limited were to be allotted to equity shareholders of Thin Limited. The directors of Fat Limited revalued the fixed assets of Thin Limited at 41 lakhs. Let's start. Now, one good thing about this sum is they've already given you the PC. They've said that all the assets and liabilities of Thin Limited are taken over at 40 lakhs. So first we are going to do in the books of Thin Limited, the book company that is going to get dissolved. In the books of Thin Limited. Right, let's see this. Date, particulars, LF, debit, credit. Right, let's start. First thing that you need to do is you need to transfer the assets. The first thing that you need to do is you need to transfer the assets. Right, so in that case the entry for that will be realization account debit, realization account debit, transfer all the assets. The assets are two fixed assets, two investments in Madhyam Limited, two investments in Madhyam Limited and two current assets. Now they have said something about investments in Madhyam Limited. They have said that all assets and liabilities are taken over by Thin Limited other than investments in Madhyam Limited. Okay, investments in Madhyam Limited are not to be taken over by them. So it will be fixed assets and two current assets. Right, two current assets and that's it. Now fixed assets of Thin Limited are 40 lakhs. No, fixed assets are 25 lakhs. Fixed assets are 25 lakhs. Current assets are 30 lakhs. This is going to be 75 lakhs. Right? This is being assets transferred. This is how you transfer the assets, right? So 75 lakhs. Sorry, 55 lakhs. Right? Now, being assets transferred. Right? Once you have this, then let's see this. The next thing that you need to do is transfer the liabilities. So when you transfer liabilities, the liabilities that you have are secured loans, secured loan debit, then you have unsecured loan, secured loan debit, unsecured loan debit, loan from Fat Limited, 2 loan from FAT Limited, secured loan, unsecured, yeah, that's it. 2 realization. These are only assets you have. 2 realization, right? Secured loans are given to you as 10 lakhs. Unsecured loans are given to you as 5 lakhs. Loan from FAT Limited is given to you as 5 lakhs. So this is going to be 20 lakhs. Being liabilities transferred. Right? So the first thing that you need to do is you need to transfer assets, next transfer liabilities, next transfer preference shares. Right? Let's see this. Preference share capital account debit. Leave a line to preference shareholders. Right? Preference share capital is given to you as 15 lakhs. Preference share capital is given to you as 15 lakhs. Right? Now, the adjustment says that Thin Limited, no. Third adjustment. Preference shares of Thin Limited were to be allotted the debentures received from FAT Limited. You are receiving debentures of 12 lakhs and 10,000 equity shares of FAT Limited. Now each equity share is of 14 rupees. 10,000 shares into 14. Someone please do 10,000 into 14 plus 12 lakhs. So 13 lakh 40,000. The total payment that is going to be made to preference shareholders is 13 lakh 40,000. They are going to be given debentures of 12 lakhs plus 10,000 shares, and the value of each share is 14 rupees. So that's 1 lakh 40. The difference is going to be called as 2 realization.
1 lakh 60.
2 realization 1 lakh 60,000. Mean preference shares transferred. Right? So we get this thing here. So that's how you transfer the preference shares to the preference shareholders. Right? Right. Once you have transferred the preference shares to preference shareholders, next you finish transferring. Now transfer the equity shares to equity shareholders. So this will be equity share capital account debit. What are the reserves you have? You have share premium, capital reserve, and other reserve. Share premium account debit. Share premium account debit. Capital reserve account debit. Share premium account, capital reserve account, other reserve account debit. To equity shareholders. Right? Equity share capital is given to you as 20 lakhs. Equity share capital is given to you as 20 lakhs. Share premium is given to you as 5 lakhs.
10 lakhs.
Capital reserve 10 lakhs.
And 15 lakhs.
And other reserves is given to you as 15 lakhs.
50.
Right?
50 lakhs.
50 lakhs.
Being equity shares transferred. Right? Now, once you have transferred the equity shares, record the PC. Record the PC, name of the new company. The new company is going to be FAT Limited. So this is going to be FAT Limited account debit. FAT Limited account debit to realization. Right? Amount is going to be 40 lakhs. Being PC recorded. Right? Now, once you recorded the PC, then you have to discharge the PC. right? Whatever you're going to get, you're going to get debit what comes in. You're going to get 12%, no. You're going to get 15% debentures, 15% debentures of Fat Limited debit, equity shares of Fat Limited debit to Fat Limited, right? You're going to get debentures of 12 lakhs and total PC is 40 lakhs. That means you're going to get equity shares of 28 lakhs being PC received, right? Once you have received the PC, the next thing that you need to do is discharge the PC. First, pay the preference shareholders. So, preference shareholders account debit. Preference shareholders account debit, they are going to be paid with 15% debentures of Fat Limited, and they are also going to be paid equity shares of Fat Limited, right? Preference shareholders, they are going to be given 12 lakh worth debentures of Fat Limited, and they are going to be given 10,000 shares at 14, so that's 1,40,000, so that's your 13,40,000, right? Next, they are saying that all assets are taken over except investments in Madhyam Limited, which in the last line they said the balance of equity shares received from Fat Limited and the investments in Madhyam Limited are to be given to the equity shareholders of Thin Limited. Okay. Now, this is being preference shareholders paid. Right? Once you've done that, in that case, give the investments in Madhyam Limited to equity shareholders, debit the receiver. So this is going to be equity shareholders account debit. To investments in Madhyam Limited. Now investments in Madhyam Limited are of 30 lakhs. Being investments given. Next, transfer the profit or calculate the profit or loss and transfer to equity shareholders. Someone do the calculation, guys. 55 lakhs minus 20 lakhs minus 1,60,000 minus 40 lakhs that's it. Someone tell me what? 6,60,000 negative, right? 6,60,000 negative, that means that should be a profit. So that will be realization account debit. Realization account debit to equity shareholders. Amount is 6,60,000. 6,60,000 being profit transferred. Right? Once you transfer the profit to equity shareholders, next you have to pay the equity shareholders. Pay. Debit the receiver. Equity shareholders account debit. To equity shares of Fat Limited. Right? Now we had received total 28 lakh worth shares from Fat Limited. Guys, we had received total 28 lakh worth shares from FAT Limited, out of which 1 lakh 40,000 are given to preference shareholders. That leaves me with 26 lakh 60,000. That leaves me with 26 lakh 60,000. 26 lakh 60,000 being equity shareholders paid. Right? So thus we finished journal entries in the books of Thin Limited. Now we've got to do journal entries in the books of Fat Limited. Right? Let's see this. How do I do journal entries in the books of Fat Limited? First thing, you will have business purchase account debit. Business purchase account debit to liquidator of Thin Limited. Right? Amount is 40 lakhs. This is being business acquired. Right. Once you acquire the business, the next thing that you need to do is take over the assets and liabilities. Right. That's how do we take over the assets and liabilities. The assets that are going to be taken over are nothing but fixed assets. Fixed assets account debit. Then the next you have, you're taking over the assets are current assets. Current assets account debit. Fixed assets account debit, current assets account debit, and two, the liabilities that you are taking over are secured loans. Two, unsecured loans. Two, loan from FAT Limited. Two, business purchase. Right? Fixed assets are 41 lakhs. Right? Current assets are of 30 lakhs. They were 40 lakhs, and in the last line they said that the company has decided, see the last line, the director of FAT Limited has revalued fixed assets taken over by Thin Limited at 41 lakhs. Secured loans are of 10 lakhs. Unsecured loans 5 lakhs. Right? Loan from FAT Limited 5 lakhs. Business purchase we know is 40 lakhs. Someone please find out the difference and tell me how much is the difference?
11 lakhs.
11 lakhs. Which side is bigger?
Of debit.
Debit is bigger. Debit is bigger. So this is going to be 2 capital reserve. If debit is bigger, the difference is written as capital reserve. If credit is bigger, then the difference is written as goodwill. 11 lakhs. Being assets and liabilities taken over. Right? Next, once you've done this, then you have to pay debit the receiver, liquidators of Thin Limited debit. What all are you going to pay them? You are going to give them equity share. Which is going to be issued to them at a premium, to security premium, and you are also going to give to them 15% debentures. are 40 lakhs, right? Equity share capital. Now we have received equity share capital of 28 lakhs. Let's see the working out, guys. Number of shares. We had issued equity shares of 28 lakhs and we had issued each share at a premium of 4 rupees. So that means we had issued the shares at 14 rupees. That means we must have issued 20,000 shares, 2 lakh shares. Sorry. 2 lakh shares. 2 lakh shares of 10 rupees each. So that is going to be 20 lakhs. Right? 2 lakhs into 4, 8 lakhs is the premium. And 12 lakhs is the value of debentures being PC paid, right? So you paid PC and besides that there's no change in debenture or anything like that. So those are the only 3 entries there. Let's make balance sheet of FAT Limited. Balance sheet. Liabilities, rupees, assets, rupees, authorized share capital, right? Authorized share capital, have they given you? No, they haven't given you authorized share capital. Put question mark and tally it off, right? Then you are issued and subscribed capital, right? Issued and subscribed capital, you are making balance sheet of FAT Limited. In that case, you will have equity shares. Now you already had equity shares of 50 lakhs plus you have issued equity shares of another 20 lakhs. 50 and 20, 70 lakhs. Right? Then there is no preference shares. Straight away you move on to reserves and surplus. Under reserves and surplus, you had a share premium. Share premium of 10 lakhs plus you just got another 8 lakhs from here. So 10 plus 8, 18 lakhs. Right? Then you have capital reserve which is 15 lakhs. Capital reserve which is 15 lakhs plus you have another capital reserve here of 11 lakhs. So capital reserve is 15 and 11. So 26 lakhs. Right? Then you have other reserves. Is 40 lakhs. Right? Do we get this in clear? Next, then you have secured loans. Under secured loans, you have issued 15% debentures. You have issued 15% debentures of 12 lakhs. Right? And you have other secured loans of 20 lakhs. You have other secured loans of 20 lakhs and you have taken over secured loans of 10 lakhs. You had secured loans of 20 lakhs, you have taken over secured loans of 10 lakhs. So 20 plus 10, 30 lakhs. Right? Then you have unsecured loans. Under unsecured loans, you have 15 lakhs and you took over another 5 lakhs. 15 and 5, that comes to 20 lakhs. Right? Then in unsecured loans, you have loan from FAT Limited. I'll show you where we make an entry for that. We will not make an entry for that here. That's it. And you have current liabilities? No. Nil. Let's move on to the asset side. Fixed assets. They are saying that fixed assets are to be valued at 41 lakhs, and you already had your own fixed assets of 60 lakhs. 60 lakhs plus 41 lakhs, 101 lakh. That's 1 crore 101 lakhs. 1 crore 1 lakh. That's your fixed assets. Then you have investments not there because you did not take over the investments in Madhyam Limited. Investments are nil. Then you have current assets. In current assets, you have loan to Thin Limited. Now see, you had given a loan of 5 lakh to Thin Limited and you have purchased Thin Limited. You had given a loan to a company, you have bought that company. Will you get that loan back? No. Because the payer of the loan is also the same and the receiver will also be the same. So loan from Thin Limited is 5 lakhs. And remember I told you I will show you this entry later. Here you will subtract that loan from Fat Limited. So loan from Thin Limited, when you have intercompany loans, right? I had given loan to a company and I purchased that company also. That is called as intercompany accounts or intercompany loan in this case. You have to write off the intercompany loans here. So loan to Fat, 5 lakhs. This is going to be written off over here. So this becomes nil. Next you have net current assets. Net current assets, you had assets of your company of 85 lakhs plus you took over another 30 lakhs. So 85 and 30. Someone please add that. 115.
15 lakhs.
Right? I think we've taken over all the assets. Now someone please add this and 2 crore 16 lakhs. 2 crore 16 lakhs. Right? Balance sheet tallies. We'll stop this here for the day. Thank you very much.